We are live for week 4 of our underwriting multifamily for beginners class, or the basics class. I'm sorry about last week. I had to reschedule. My husband was out of town and my daughter's birthday plans kind of fell through. So we decided to plan a little family birthday party for her. And I loved her reaction when I said, I have to reschedule this class tonight last minute. And she's, oh, what are you going to tell them? What are they going to say? And I said, they're going to say family first. That's, of course, awesome. I knew in my professional world, my colleagues would be extremely understanding of family first. And I thought that that was just a great reflection on everybody's reaction to the fact that I had to reschedule at the last minute. So thank you for being flexible and thank you for coming today, even though it was a little bit hectic because of last week. So welcome to week 4 of the basic class for underwriting multifamily commercial real estate deals. We're going to get started right away with going through what you do once you've decided that you like the deal, you've done your first round of due diligence, you've vetted the team, you've looked at the spreadsheet pro forma, vetted the numbers, you've read through the PPM or the legal disclosures, and now you're actually ready to sign some documents, fund a deal, attract the deals that you have, then figuring out how to get more cash to invest, either freeing up your own cash from some of your resources you may not realize that you can invest with, or being able to raise capital from some people in your limited partner network. So we're going to start out. I'm going to share my screen of my portal that I use for managing my investors. Can everybody see the screen here?
Yes.
We're going to start here with Syndication Pro, which is the portal that I use to manage my investors, but I can also use it to invest in other people's deals. So the thing about a portal is you're going to need a different login for every company that you invest with. So if you invested with a deal that I was sponsoring, you would create a username and login for my website, but even if somebody else is using the same platform of Syndication Pro, they might have a different company name like syndicatora.investmentportal.com. You'd have to have a different login. So every time you want to invest in a deal, you're going to have some sort of investor portal or sponsor portal that you're going to need to go through. So you're going to start out there and you're going to create an online account so that you can log in and poke around and see all of their offering details. Now, sometimes when you log in, you won't see anything here, especially if it's a 506B, because you're going to need to be some sort of a verified investor. There's a little button that the syndicator will click saying that they've verified your relationship, meaning they've had some sort of a phone call with you or some sort of an interaction that they can document that shows that they have enough of a relationship with you that they can release their 506B investments to you. So sometimes you have to contact the operator and say, I'm logged in, I'm signed in, and I don't see any deals, and then they can go and verify you and show you the deals. And a 506B, again, is just one that cannot be advertised and has to have some sort of either word of mouth spread, referral, or previous relationship in order to invest in that. And that's why they don't all the time show up. The other reason it might not show up is, for example, this one is a 506C, which we can publicly advertise. However, we can only accept accredited investors. Accredited investors have a net worth of $1 million or more, not including their personal home, or they make $300,000 a year married filing jointly, or 200 filing separately. And there are some licenses like a Series 65 or a Series 7 license that you get if you're a financial planner of some sort. Or if you work for the company that is offering the investment, you can have a professional accreditation. And the rules on that are still pretty vague because they just came out with that update and we don't have a lot of clarity there yet. So if you're not an accredited investor or you haven't told the operator that you are an accredited investor, you may not be able to see the 506C deals that are in the portal. So you sometimes will just have to let them know, I'm signed in, go ahead and release it. And then when you click on your portfolio tab over here, and then you click on offering details, it'll pop up with the deals that you are qualified to invest in. The nice thing about this is we can keep all of our documents and all of our information in one spot. So you can come down here and you can see that there's a gallery, and this will be some pages from our offering memorandum or our pitch deck. And sometimes they'll have the entire pitch deck in here. Sometimes they'll just have select pages, selected highlights, things like that. Let me see who's got your hand raised. Go ahead and ask your question, Chris.
Yeah, so just real quick, how do we get verified as an accredited investor?
Oh, how do you prove it to them once you've told them that you're accredited?
How do we get verified, or they just take our word for it?
It depends on the type of syndication. So if it's a 506B, they can have up to 35 unaccredited investors. And if it's a 506C, they can have only accredited investors are allowed in a 506C. So on the C, you have to prove it somehow. It's actually the sponsor's responsibility to verify it, but because we don't want that liability of verifying it, usually we'll send you through a third-party service, something like verifyinvestor.com or parallelmarkets.com is a free one. You just go in there, you upload your tax documents and some other things that they'll ask you for, depending on if you're going through income, professional certification, or net worth. You're going to upload the documents that they require, and then you're going to send that paperwork documentation to the syndicator on a 506C to prove that you are accredited. If you've already done it for a 506C, sometimes it's nice to send it over for a 506B, because even though you can self-identify on a B, nobody has to check for you. If they get close to their limit of 35 and they go over that because somebody said they were accredited, but they actually weren't, they can get into some hot water. So if you have that documentation, go ahead and send that over. If you don't on a 506B, it's fine, but you just have to make sure, if you are not quite sure you're accredited, that you might want to go check it out for yourself just to make sure, so you're telling them the right thing.
Okay, so it's like per syndication that we just send out whatever proof then. Okay.
Yeah, you have to do it syndication by syndication, but you can save the documentation that you got. You don't have to redo it every single time. And even when we're going through the club, we're investing as joint venture partners, but on a 506C, because we're not managers or executives on the deal, we're considered to have non-managing member shares of the general partnership or the managing partnership. So even though we're not limited partners, we still have to be accredited, because on a 506C, everybody involved in the deal has to be accredited, limited partners and anybody who's not a manager or an executive on the actual deal. And that would be the person who's running the asset management day to day, the person who found the deal, the person who's signing on a loan. They don't have to be accredited because they're considered executives. But for non-managing members, which is what we generally negotiate through the club, we do have to be accredited. We were hoping that we could get into some manager position on some deals, but it's difficult because we need to have a good relationship with that operator that we'd actually want to partner up on that deal. So there are a few operators that we're talking to that would give us that opportunity to be managers on a deal. But for the most part, we'll go in with our pool of capital and we'll be non-managing members of the managing partnership. We are going to start looking at these documents, and you're going to see 3 documents that you have to sign in order to be legal. Sometimes there'll be some extra ones in there, like here's our offering memorandum, which is basically our pitch deck. The pitch deck is also included in the PPM, which are the legal disclosures. And so sometimes you'll have that duplicated. So we went ahead and uploaded it, but it is duplicated again in this document here, the PPM. And so we'll view this document. And like I said, these are all the boring legal disclosures that we covered in our class last week. And I'm sorry if I said boring, if you really like reading very dry walls of text, if you're an attorney or an insurance broker or something like that. But you see how in here the pages from the pitch deck are included. And the reason this is important to point out is because this pitch deck is part of our offering. It's part of our marketing. And if we say something in the pitch deck that doesn't agree with what we showed you in a webinar or doesn't agree with what's in the PPM, this is actually a legal document, this offering memorandum. And so you're going to have to be familiar with it, and what it says, what they told you, may even trump what's in the PPM. So that's why it's included in there. We're also going to go through the company agreement, and this is the operating agreement for the LLC of the partnership. And you're going to see what their company's all about, how they're planning on handling it if somebody dies, or if they want to do a buyout, or how they're going to handle it if they need a loan to the company, if they're going to do some sort of a capital call, transferring shares, voting ratios, the purpose of the organization. You're going to go through this and you're going to read it over, and you're going to make sure that you understand it and that you're ready to sign, basically that you read it. Then you have an investor questionnaire, which is not a legal document that you have to sign, but a lot of sponsors will want you to answer this because they really want to document how they met you, what your qualifications for investing are. It's more of a protection or an insurance for the sponsor. So you will often see these in here, even though it's not legally something you have to sign. A lot of sponsors will request it. And you see it's pretty long. So if you want to skip this, you probably can. And the operator will sometimes say you don't have to worry about it. But if you want to fill it out, especially if it's your first time investing with them, it's really nice to have that on file. The next thing we're going to look at is a subscription agreement, which is outlining what it is that you're investing in. And you're going to put down here how many units or how many shares you want, your name, the entity that's investing, and whether you're going in through a trust or an LLC, or you're going in as a married couple or a single individual. You're going to put all that in the subscription portion, sign it, date it, and just say that you understand that you're investing in a security. And with security, there's risk of loss and those types of things. The last thing we have is the accredited investor verification. And we just wanted to upload some helpful instructions for people who were looking for a way to be verified. And we use, like I said, a third-party portal like Verify Investor or parallelmarkets.com. Often the portal will allow you to sign on the platform itself, which is really nice. You can see that I've already completed these documents. And when I open this up, it's basically the same thing that I already looked at, but it would be the signed copy instead of the blank. So this is all of them in one document, and it'll be set up just like a DocuSign. Some portals will either not allow e-signing, or some of them, I know operators just don't like using that feature because it's not very user-friendly, and so they'll set it up in DocuSign, so you may need to go hunt those documents down. Just make sure you follow the instructions from the operator that you're investing with, because oftentimes what'll happen is you'll decide you want to invest in something, and then you have to go and finish up these steps. It's not old school where they would invite you to a dinner that they paid for, and they would hand out the actual papers with a pen, you'd sign it, you would write them a physical check, everybody shakes hands, and then you leave with your tummy full. That's how we did it in the old days. And now we have to do it using these new IT tools, and a lot of people can get tripped up in this process. And so just imagine to yourself, if you go to one of those paid dinners, you listen to their pitch, that's the version of their webinar, you look over all the documents, you have to sign those documents and write them a check before you leave. That's the same process that you're going through here, is you have documents that you need to sign here in the e-sign templates. Once you sign documents, they'll appear in your signed documents. This is a little bit different for me. I don't have my documents actually here because I'm a partner on this deal. And so my signed documents are on the sponsors portal, and I'm not seeing them here. I'm a co-sponsor, and so I would see the documents that my investors brought in, but I'm not going to see my own. So it's a little different when you're a general partner. We've got another question. Kevin, go ahead.
Yeah. And do you know if you've signed in enough of these, do any of them have like progress bars that tell you like, okay, you've done this step and then you're ready to do this step? My experience, my one and only experience, was we were just kind of left to our own devices. I don't know if you've used, other than this particular one, do they have progress bars? Are those common or uncommon or what?
Well, when the deal that you and I just did together and what we signed, when I logged in, it would tell me what I had waiting in my queue to sign on that portal. I can't remember which one they were using, which brand they were using, but it did have kind of a to-do list when you logged in. But just remember, there are 3 things. You have to sign the subscription agreement, the PPM, and the company agreement. Those are the things that are going to require signatures. The rest of them you can sign or not sign. It may be some extra stuff. And then you have to wire your capital over. Those 4 steps: sign 3 documents and wire your cash. And if you can keep it to just those 4 steps in your head, all the rest of these little details can fall into place under one of those main 4 categories.
My only experience with doing anything like this was when I purchased my house. And like you said, that was done like at a table inside of 30 minutes. My experience with this was it was a couple of days and then waited on the next step. That's what threw me off, was the timing. I was just used to doing it all in about 45 minutes. This took more like 10 days.
Yeah, and I think that you may have a little bit of difficulty because when you're going through a retirement account, you have some extra steps, not necessarily extra documents to sign, but you need to go find the name that your retirement fund is and put that exact name on there. It's the documents, and they're going to release funds on your behalf.
Yeah, mine was just a little different, but
So you're going to see here also the capital calls, and we might send this out to our investors. We have an amount that they would have to fund up to 10% of their original contribution. That'll be in the PPM, what you need to commit there. And if there's a capital call, we can instigate that just through the portal. Now, we've never done that, and it would be pretty terrible if we had to do that, but it does allow for that inside of this portal. And this is the fun part, the distributions. So when we have some money to go out, we can wire the distributions or send a bank transfer directly to your bank, and you'll just see it show up as an ACH transfer. And that way we can add in our accounting and to say how much each person needs to have sent over, and we can send it straight from this portal. So this is the updates portion of the portal where we can send out emails. You should expect an email out roughly once a month, at least quarterly, and some sort of a quarterly financial report, because you're going to get a quarterly distribution in most cases. And so sometimes we'll send out a quarterly financial report as well. You at least need to have an annual one, and some syndicators are required to provide audited financials from an accountant directly. So you just have to check to see how often you can expect those communications. And if you're not getting the communications, then it might be something that you would want to look into as a way to figure out if your syndicator is communicating with you adequately. So over here in reservations, this would be where you would want to go and pledge some money in here. Once you've pledged an investment, it will show up here and it will show you what you need to do, documents you need to sign, you need to wire your funds over, that type of thing. So when you're going to wire your funds, there are certain things that you need to pay attention to. Focus on wire fraud safety. And those things would include not wiring funds without calling the syndicator on the phone first. If you receive an email update that is changing those wiring instructions, that's often from somebody who has hacked into your email account, because they will have some sort of a virus that can get in and watch for emails that say buzzwords like real estate, house, mortgage, things that are having a wire transfer. And then they will send you fake emails that may look like they're from the address of somebody that you know. Instead of an L, it'll be a number 1, things like that. So you think it's coming from your loan officer or from your syndicator operator, and they'll say, here are the updated wiring instructions, and then you'll wire your stuff offshore and it will be gone. And so wire fraud is very, very common, and it's just important to go through a couple of steps that will protect you from being the victim of wire fraud. So one, when you get the wiring instructions, if they're inside the portal, you can trust that. Don't believe anything that they send you through email unless they send you one email. And sometimes they'll say, this is the only email you receive. They're not going to change their wiring instructions because those are going to the particular bank that they bank with. And so unless they got a new bank account, they're not going to have different wiring instructions. So just bear that in mind. They're never going to need to update those. And if they did update it, I would definitely call, not the number on the email that updated you, but call the number that you have for your title officer, for your syndicator, mortgage lender. Call them up and say, hey, I received this email and it says they're changed. That's very, very fishy. And when you go to the bank to actually wire the money in, you're going to, again, want to make some sort of a phone call or make sure that what's posted in the portal is accurate, so that before you wire your funds over, you can just double check that it's going where it needs to go. Now, you're going to be more concerned about strange wiring instructions that might be overseas. That's really the big red flag, because usually you're going to be wiring it domestically for these syndicators. I've never come across one where I had to wire it overseas or to the Cayman Islands or anything fishy like that. Make sure it's a bank that you know, Capital One, Bank of America, Wells Fargo, these types of organizations. There is not much they can do if you send your wire to the wrong place and it was some sort of mischievous person who wants you to wire that over. But if it was just sent somewhere on accident and you notice it right away, sometimes you can recall it, but it's pretty scary when you send that wire to the wrong place. So just make sure that you protect yourself from wire fraud. You go through the proper steps to make sure you're sending it to the right place. And that brings us to another point about wiring funds over. You do wire funds into the bank account of the operator directly, because the way that they have their PPM or their legal disclosure set up allows that business to take capital from limited partners. If you are putting money directly into somebody's bank account, typically, and you're going to be a limited partner, either you're putting in some equity or you're a debt partner, you need to make sure that they are structuring that properly, because if you're just wiring something directly over to somebody's bank account, that can also be very risky. I prefer to work through a title company if I'm going to be doing a private loan for somebody and sending them some cash, because I want to make sure that the title company has set it up properly, that they understand that I'm a debt partner, that the note and promissory note and the lien against the house that I am going to be funding, maybe it's for somebody who's flipping a house, or lien against the property, is filed correctly. So any questions about that? It's a big deal.
Yeah, I agree. I think the scariest part of the process for me is the wiring, because it just looks like you're pressing send and the money's gone, and a couple of days later you're hoping to get a confirmation.
Yep. And if you do it often enough, eventually you will either make an error or you'll know somebody who made a big error. And like I said, the worst I've ever heard, they were able to recall the wire, but they did realize that it was going to some fishy overseas account. And this was an experienced real estate investor. So you can never be too safe. Always make a phone call and make sure that those wire instructions are verified. You can also just call the bank directly. So let's say you bank at Wells Fargo, but you're needing to send a wire over to Chase Bank. You can call Chase Bank and say you're sending a wire and you need to just verify that this account number goes to that account name. Those types of protections are don't ever feel silly about doing that, because this is so serious and it's so common that you can never be too careful, and nobody's going to give you a hard time about double and triple checking these wiring instructions. When you get your distributions later through the portal, those tend to be sent through an ACH transfer. And the reason why is just because they're a lot smaller. We're not going to be able to send an ACH transfer of $50,000 or $100,000. That really does need to be a wire, unless your sponsor accepts cryptocurrency, which I'm seeing more of that. But to me, it's still a fishy red flag. But once they start accepting cryptocurrency, you may be able to do it that way. But typically, you're going to send large amounts through wire, and then the smaller amounts you're going to be getting through the distributions will be an ACH. And then when they send you a big chunk of money from a refinance or a sale, oftentimes they will have to wire the money to you. Sometimes they even wire you the distribution. It just depends on the operator.
Yeah, I have a follow-up to your question about title company. What do you recommend about how you find a title company? How did you go about that?
Typically, the person that I'm lending money to will have the title company chosen for them. And so I'll call the title officer, I'll check their number, their license number, and make sure that it's a legit title company and that the person is a real title agent. Title companies, they're all kind of the same, except they're all different. Really, what you're looking for with a title company is someone who's extremely organized and is doing their numbers and their documents and their paperwork correctly every single time. So you just want to find somebody who's doing this as cleanly and efficiently with the least amount of errors as possible. Raquel says referrals. That's absolutely right. I have had good and bad experiences with referrals, because sometimes I'm just on the receiving end of a transaction that just didn't go well. It's just the way it goes, and they can't be perfect. And if that's the one I happen to catch them on, and sometimes it's bad enough that it leaves a bad taste in my mouth, even though it's a referral, even though everybody in my network uses them. I've had it happen a couple of times before, and it just varies state by state. Sometimes you have to have a lawyer attached to a title company. Sometimes you have to close through a lawyer. Sometimes the buyer can choose a title company. In some states, it's the seller. Some states, you can have two different title companies. It really depends on the state. They are the ones who regulate these transactions, so it's not going to be the same across the country.
So if we participate in an investment, do we have access to this portal now?
Are you asking if you still have access to the portal that you use?
This one that you're referring to now, is this the club's portal? Or is this yours specifically?
This is mine specifically.
Okay. Like, this is not something that if we did, several different investments with the club, we go to this portal and we see all those investments? Or are you just using this as an example?
You would see all the ones that you had with that particular company. This is the Syndication Pro portal sign in. That's going to be different. You'll have Invest Next, you'll have Appfolio, you have Cashflow portal. There are different portals that operators can use. But even if the operator is using Syndication Pro and I'm using Syndication Pro, it's still a different login. So you see it up here at the web address where it says highrise.investmentportal.com. It would have the company name there, like syndicatorabc.invportal.com. And so everybody has their own. And so if you do multiple investments with me directly, when you log into your portal, you will see them all listed there. And that's very common. Once you vet out an operator, you want to keep investing with the same operator if they do a good job for you. But you do have to sign up for a different portal with every single operator that you invest with. Once you have signed up for it, though, that's the easy part. You log in, and that's where you're going to have to sign documents every single time, even if you're investing with the same person, unless you have an accredited investor verification that you sent over. You wouldn't have to redo that every single time.
Okay, thank you.
Is Syndication Pro pretty common among operators, or is it mostly Syndication Pro?
Syndication Pro is probably one of the more common ones because they were first to market. Portals that are for larger operators, hedge funds, institutional funds, sometimes they'll have one in-house that they had specifically built for them. And so it may be different or new and you haven't seen it before. But for smaller syndicators, I would say Syndication Pro is right up on top. We've had another groundbreaker that came in, and I know Appfolio does one. Juniper Square is one that's a little bit more pricey, and so usually only larger syndicators will use it. InvestNext and Cashflow Portal are some newer ones to the market, and I'm starting to see more of those. It really just depends, and as time goes by, we're going to have more of them in the space, and then eventually they'll condense down to the industry leader. And the first to market isn't always necessarily the best one, but it usually has early adoption because it's the best option until people realize, hey, we can deliver a product in this space and make some money off of this space. And so I'm definitely seeing more portals becoming available.
Hey, is Syndication Pro considered like a marketplace, like a two-sided marketplace where an operator would, I guess, advertise their opportunity and then also find investors, or am I missing that?
No, they don't do that. If you're going to be looking for investors or advertising your opportunities, you're going to be using your website. And there are rules that the SEC creates around what you can advertise even on your own website. I would stick to advertising 506Cs on your own website. And if you have done a B already and the subscription is closed, sometimes people will put that property in some before and after pictures, but they don't share a whole lot about it. And they certainly would never advertise it while they're still raising money for it. That would be on the website. You can also get some sort of a CRM. A CRM is a customer relationship management tool. It is basically a way that you can keep track of everybody that's in your network. It's more than just contact information. You can actually put them into to-do lists or pipelines like, hey, this person is new. I need to send them out this or do a follow-up call. You can schedule certain actions attached to that potential customer so that you can keep track of it. They're very popular in any kind of a sales organization or small businesses who have to keep track of their customers. Syndication Pro does have some CRM capabilities. I can send emails out through there, and it's not just updates to my investors. I can send emails out to my leads who've never invested in a project. And if you've received an email from me before where it says, hey, we're having a club meeting tonight, just a reminder, or here's a new deal that we're going to be investing in, I send those out through Syndication Pro. So it does have some light CRM capabilities. The other thing that you're going to want to remember is that any kind of CRM that you're going to use, HubSpot and ActiveCampaign are the two that I hear used most often. And they're usually going to charge you by how many users you have in there. And so the bigger your list is, the more you're going to be paying. And there are some that only charge you based on the fact that you're using it. It's the same flat monthly fee for everybody who uses it. And some of them are going to charge you by user. So if you're raising capital, you do want to find some sort of portal that you can use and some sort of CRM that you can use. There is one that has come out recently that I just signed up for. Obviously, I don't have anybody in here, haven't used them at all, but this one is free to use until you get an actual deal. So Syndication Pro, I think, is $100 a month for just using it. And even if you don't have a deal in it, if you are a co-sponsor on a deal, meaning that you're not the lead syndicator and they just added you as a co-sponsor because you're going to help raise money or you're going to help do investor relations, whatever that looks like, you do get a free portal as a co-sponsor. But if you are actually hosting the deal, or if you sign up for Syndication Pro on your own and you have no deal, then you will be paying a monthly fee for that. And then each deal you do will have an additional monthly fee. Whereas Cashflow Portal, this new one, it is free until you get a deal and then they'll charge you. And so you're going to have to compare the pricing on this. But this is a great place to start for people who don't want to pay $100 a month when they haven't raised a single dollar. And so you can go in here and use it in very much the same way as Syndication Pro. And you can have the deals listed here. All of your documents would be uploaded once you're having things ready to sign. Here's where you put in all of your leads. So adding a contact, this looks very much like a CRM. You would want to have some sort of tags. You do have a lot of options here. You can put in your biography. You can share this portal with people. So I share my Syndication Pro sign up portal. If you see here, this link that I have for the sign up, I share that. I put it on all my social media. I want people to sign up. So I'm perfectly able to advertise my portal. I just can't advertise my deals, and I can't make marketing hype types of promises about my deals. That's where you start to run afoul of the SEC. The chat has some questions about title companies have also suffered breaches, so hackers will know what transactions are being worked on to close. Exactly. It's a lot harder to hack a person-to-person phone call if you call the correct number. So that's why we always call. So we're going to look at Cashflow Portal as an investor, where I might have a portfolio here of different deals that I've done, and they'll give me a summary here. I would love it if this included all the deals that I did with any syndicator using Cashflow Portal, where I could see all of the deals in one spot, because I know that Syndication Pro doesn't offer that feature yet. If once you log in to see your portfolio, you have to log into everybody's individual portal in order to see that deal. And so we'll get to how to track different deals when sometimes you actually lose track of what you've invested in. And that's how you know you've arrived, when it starts to get difficult to keep track of what you're doing. So connections here would be the sponsors. So if I meet a sponsor at an event, when you meet a sponsor who might have a deal, you want to make sure that you follow up with them and have a phone conversation, let them know your net worth, let them know your investing experience so that they can mark you down as verified so that they can share their 506B deals with you. So you're going to meet them by going to conferences. If you walk into a conference as a limited partner, people are going to be all over you because that's like the holy grail. And when you're fishing for limited partners at a real estate conference, you usually are not going to find a whole lot of people who are only there to be limited partners, but sometimes you'll find them in meetups, sometimes you'll find them at conferences. The best thing to do when you're at a conference and you're trying to meet somebody, if you're a limited partner, everybody there is going to want to put you on their list. Great. You just start taking down names and make sure that you schedule follow-up phone calls with all of them so you can make sure that you're on their verified list. If you are a syndicator who is looking for limited partners, you can still find them at conferences. You just have to make sure that you're going after the ones who are making enough money that they have excess cash to be able to invest. And that's not going to be any different than a lawyer conference or a medical conference or a conference for e-commerce sellers. You're not looking for the people who are new and cash strapped. You're looking for the people who have achieved some level of success in whatever profession that they're in, whatever conference that you're at, and they are going to have excess capital that they want to invest. Even other syndicators. I invest in other syndicators' deals. Most syndicators do, because how many deals can we do? And when we make a big chunk of cash, what are we going to do with it? If we don't have our own deal, we're going to go out and keep that money moving in other people's deals. So you can definitely meet people at conferences and real estate events. And the hurdle is lower because they already like real estate. They're already interested in real estate. And so you can go ahead and put them on your list. Just make sure that you're looking for the right ones, the ones who will have extra money at the end of their active income that they might want to passively invest in it. And they don't have so many deals. They're not so big that they always are having to put their own money in their own deals, because that happens as well. So you're kind of looking for that middle ground there.
As a follow-up there, is there no like online marketplace that would be the virtual equivalent of what you just described?
There really isn't, unless you are in some sort of a crowd fund like Yield Street, Crowd Street, Fundrise, those types of things. They will have an online marketplace for deals, but you're not going to advertise on those platforms unless you are in the crowd fund. So basically what Yield Street is, or Crowd Street, they open up a portal and you can put your deal on there if you have the right type of syndication structure to be able to advertise there. There's also a Regulation CF type of fund, and that's a lot less work than an A+, and so it's better for smaller syndicators. But again, there are only a few portals, and the SEC will have a list of them where you're going to go to those portals and look for those crowdfunded deals. The more money you can put in one deal, the better returns you tend to get. So the kinds of syndications we look at, there's no marketplace that I'm aware of. I just have to go to conferences and I just have to meet the operators that I want to invest with, either to raise money for them or to put my own cash into those deals. But usually you're going to have, the marketplaces are going to be supported by certain types of structures. So for example, we're seeing new marketplaces arise that will allow tokenization of the real estate, where you, instead of buying shares in the company, you will get certain numbers of tokens and you can sell those, buy and sell those, and you don't have to keep changing the operating agreement or the limited partner is coming in and out. You just basically sell the token. So those investments become very liquid, because typically these real estate investments are very illiquid. You can't get your money out unless there's some sort of a refinance. Transfers tend to be more difficult. You have to find your own person, whereas you might have some sort of tokenized marketplace where you can buy and sell your tokens. And so the only deals that you're going to find on there are the people who are using that tokenization service. And so for people who are outside a Regulation A+ or a CF fund, or a tokenized platform that we're going to start seeing more of in the next couple of years, then the best way to find them is really you have to go to the source. And that's one of the reasons I started the club, was so that when I had cash to invest, I had a group of basically gym buddies that I would be keeping up on who's actually still doing deals, who's still offering deals, what are the deals that are out there right now? Because if I only look at it every 3 years when an investment comes back, I'm going to be completely out of the loop. And so for me, the investing club is a way to stay accountable, to stay on top of these types of investments in a way that I enjoy doing. And it's fun for me and doesn't take too much time once a week to get together with my real estate friends and talk about who has what deals and who's doing what, because it is constantly changing. I do know of one 506B portal where they can't advertise deals, but they can advertise themselves as operators. And so you can go in there and basically say that you would like to meet them, and then you can schedule your call offline. And the purpose of that is so that they can document that you found them on that website. And that's a way that they can say that they had a relationship with you prior to you investing in one of their deals. Right. right, I'm going to switch gears now from raising capital, finding operators, into managing your own portfolio, because it can get kind of tricky. So this is a dashboard called Visor, VYZER.co, and this allows you to put in various investments that you have from around the internet into a single dashboard so that you can keep track of them. And this is something that would be a step above a spreadsheet. The first thing always is just write it down on a spreadsheet, write down the contact information of who you need to reach out to, the bank account that you have going into it, when it's supposed to mature, just as much information as you can, so that when you're saying, hey, why didn't I get my quarterly distribution, or I was supposed to get a monthly check and I didn't get a check this month, how are you going to keep track of that? A spreadsheet, and then taking this one off to the next level right here. And so you can track your loans, your credit cards, your crypto, savings, brokerage accounts, loans, private company like a startup that you've invested in, any kind of a managed fund. And this is where we're going to be interested in real estate. And this is just a demo right here. You're going to put in the asset name, the cash that you have invested, and then it can start to calculate your entire portfolio returns that you can see here up here in the overview. And this just helps you to be able to track these things. And so I thought that it was useful to share, to show that if you are getting a lot of assets and you're struggling to be able to take charge of monitoring them, because like we said, if you're in Syndication Pro, you're not going to see all of your deals that sponsors have used Syndication Pro. You're going to have to log into each one of them individually. Another tool that I like to use for this is a password vault, like 1Password or LastPass. I can make private notes in there that are secure if nobody hacks into the database, which has been known to happen. But I can get into there to some secure notes and just make a list in there of things that if I die or if something happens to me, that my loved ones who I have shared that password vault with will have a list of all the things they need to go check. And it has my life insurance policies on there. It has all my properties, contact information. And then I also have a spreadsheet, but since that's not in my mind as secure, being on the cloud, I like to have the most secure information in my password vault or in a dashboard like this. Now, I don't use Visor. This is one that I just heard of recently, but I thought it would be worth sharing because I'm going to start playing with this myself as a way to track my investments. So the last thing I wanted to talk about was how to free up some more of your own cash so that you can also help your investors learn how to free up their cash, because there are things that we have at our disposal to be able to invest with that we might not recognize as cash. Now, I will start out with some of the easiest things, obviously just cash in the bank, right? If you are a high income earner or you're doing some deals and you do something transactional and you get paid a big chunk of cash, maybe you flipped a house or maybe you got some sort of a bonus, obviously that cash would be the easiest to invest. You've already paid taxes on it and you don't need to get it out of a retirement account. You just can go ahead and put it into a deal. Now, some other ways that you can free up cash is from other real estate that you have to sell. You can sell it and you can either put that money in with a custodian and do what's known as a 1031 exchange. There are a lot of rules around that, and it's hard to get into a syndication with 1031 money unless you have several $100,000s to be able to invest, because legally it's more complicated. And so if you just have a little bit to invest, sometimes you'll just want to pay the taxes on the gain if you sold a house or sold some stock or something like that. And then you want to go move it into a different project that maybe has depreciation. And so this is a very common way for people who are making some sort of active income from either stock sales, or they're high paid professionals, or they're doing deals where they get a large check all at once, sales guys, that type of thing, where they can take that cash and instead of paying their capital gains taxes on it, they can then turn around and put that into some sort of a deal like a syndication. It doesn't have to be like kind. A 1031 exchange requires the properties to be similar. You can change from a single family to multifamily, but you have some restrictions on what you can invest in if it's considered like kind or not. It also has to be done in the same entity in which you owned the previous one. So if you own the previous one in My Name LLC, you can't go into a syndication using My Name LLC because the title of that new property is held in Syndication LLC. And so the way that you would do that is a legal agreement called a tenants in common, or a TIC, or a TIC. And what you would do is you would say, okay, My Name LLC is going to partner up with Syndication LLC, and we're going to form a tenants in common where I actually hold part of the title to this property. And when you invest in a TIC with a syndication, you are one of their joint venture partners. And that's why you have to have a big chunk of cash that you want to bring into it, because they don't want to just partner up with anybody who has $10,000 or $50,000 coming out of a 1031 exchange, because it's a big commitment and it's a relationship. And so you want to make sure you have enough cash to be able to go in. And that's the same thing that the club does, in a way where we'll pool up our money and we come in with a big enough chunk of cash that they are motivated to work with us and develop a relationship with us and allow us into the general partnership. And so if you want to be in a GP or you want to do a TIC, you need to make sure that you have enough pool of cash with you that you're going to be able to make that work. And you'll also probably be required to pay the legal fees that TIC would entail, which can sometimes be $10,000, $20,000, $30,000 just to get the documentation done. It really depends on the lawyer and it depends on how complicated the transaction is, but you should be prepared to pay that. So the other option outside of a 1031 exchange is to just not pay the taxes and to put it into a project that has a lot of depreciation, because then if you do that in the same year, you buy and sell in the same tax year, then what you can do is take the depreciation off of the new property that you just bought into. Even if you're some sort of a joint venture partner, sometimes even as a limited partner, you can get a lot of depreciation. It really depends on what type of job you have and how you structure your own taxes. There are a lot of what ifs there, where if you want to use that to be able to offset your capital gains taxes, you can then use that depreciation. And so yes, you will pay taxes on that money, but then it's offset by all the taxes that you didn't pay because of your losses from all the depreciation. So moving your money from one type of investment, whether it's real estate, stocks, whatever, into real estate that has depreciation is very attractive for people who want to be able to use the depreciation on their taxes. So understanding this better, and I'm just giving you a brief overview, it's definitely a rabbit hole that you can go down, but you're going to want to do some research so that you're giving your potential investors and yourself good advice on how you can move money from one type of investment into another one, not using a 1031 exchange, because you're going to be taking advantage of the depreciation. Again, a lot of people cannot use very much depreciation. W-2 workers would probably be at the bottom of the list, and then a real estate professional would be at the top of the list. And so what I think is the best combination is a W-2 worker with a real estate professional spouse or partner where they're filing jointly. I happen to be a real estate professional on my taxes because I don't have another job. This is my full-time gig, and I spend at least 750 hours a year working on my real estate business. And I'm significantly involved in the management of the source of my passive income, meaning I do self-manage a small portfolio of my residential properties just so that I can get enough hours and enough say of I am substantially involved in the management. I also go to weekly asset management meetings on all of the properties where I am making a significant amount of returns from, because I need those hours and I need to say I'm involved in the management for IRS purposes. This allows me to take my passive losses, which is depreciation, against my active income, which would be acquisition fees, or if I flip a house, those types of things. And it even applies to my husband's W-2 income. I can offset his active income by my passive losses. And I would not be able to do that unless I was a real estate professional. And so sometimes you'll have a high paid individual, like a doctor would be a good example, and they may have a spouse who's not working, but the spouse will take over the portfolio management of the real estate investments or the other investments they have, spend at least 750 hours a year, be significantly involved in the management, and they can then become the real estate professional for tax purposes and have that income go against their active income. And that's how a high paid W-2 or a high paid business owner would be able to use more depreciation than they would if their spouse that they're filing with is a real estate professional. So knowing these types of things will allow you to talk to your limited partners and show them the benefits of investing. Like, I can't use depreciation because I took my $10,000 a year that I get off my couple of rental houses and I maxed out. And you say, oh no, because your spouse doesn't work and she's getting to the point, or he's getting to the point where he might want to do this as some sort of a business to manage this portfolio. That could be an option that you want to be aware of for yourself, but also to be able to educate other people on. So that's one way to free up cash from your transactions or even your job in order to get the max amount of depreciation and tax savings out of it. Do you have any questions on that? The taxes can be kind of deep and nuanced sometimes.
Do you have a good referral for a tax attorney or a someone in that field?
I don't use this individual for my personal taxes. I usually will go by referral in my network. And right now there's a huge labor shortage. So I've been having problems with pretty much every CPA I've been using lately.
Right.
But I would say if you want some more information on this, Brandon Hall or realestatecpa.com has some great articles. He's extremely conservative, and so you're not really going to go wrong by following his advice. A lot of accountants are not as conservative as he is. And so if you see your accountant doing something that you feel like is a little too aggressive, you might be able to say, hey, I would prefer if we do it this way. And so some of his white papers are really informative on this, and he does a lot of podcasts and a lot of a lot of meetings and he is constantly teaching and giving out good info. And he also has a tax planning conference for real estate investors that he does once a year. There were two more things that I wanted to discuss about how to free up capital. One is home equity, and that would be against your primary home in the form of a home equity line of credit. Or if you use the right bank, you can even get home equity lines of credit against your investment homes. And this will allow you to free up equity without having to do a cash out refinance or sell the property. Although those are two very good options as well. I'm selling some of my smaller properties in order to get the equity out so that I can then go and invest in other things. Because if I borrow against them, either through a HELOC or a cash out refinance, I'm no longer cash flowing on that property. I would basically have to feed it. And then you have to make the decision. Do I want to set aside some of the cash I pull out of it in order to make that negative payment until the rents catch up to the new payment on the new loan that I just got, which is also a possibility because you could free up a bunch and go invest it. And then you could just leave some as an emergency fund and you can keep feeding it for a year or 2 years while the rents catch up so that you can become cash flow positive again. So cash out refinance is one great way. A HELOC is another great way. Selling the property outright, which is then when you have to get into like 1031 exchange or having to move it into somewhere with depreciation so you're not paying capital gains taxes. But I prefer, personally, I will put a HELOC on 1 or 2 properties, and then I can continue to use that equity. And every time I make money, I put it in there, pay it down, let it sit. And when an opportunity arrives, I'll pull it out. It's extremely liquid. And because I don't have a mortgage on that property, it's the HELOC only. I use the HELOC to pay off the mortgage. I'm able to do it with a little bit more confidence that they're not going to cap my limit or they're not going to call the entire note, because that will happen in HELOCs during times of recession, especially if it's a second lien. And so I wanted to make sure mine was a first lien so that it wouldn't get called when things were bad. Evan, did you have a question?
The HELOC was interesting to me too, like, especially if you can become a part of a syndication and get like say 20% return, but your HELOC rate is relatively lower than that. It seems like a decent proposition. That's just more of a thought, I guess. But the other question I had was, does anybody ever do margins against their portfolios to stir up some extra cash to put into an investment?
I don't personally do margins on anything because I feel like that's really what got crypto investors in a lot of trouble recently. It's very common with hedge funds. I just feel like it is a lot more risky. And if you're in the position where you can absorb that risk, then it would be a great option to free up some cash. And you just have to decide if that's something that you feel comfortable with. And the same question goes, don't invest or don't borrow what you can't afford to lose. And if the risk is more than you can stomach, then I wouldn't want to do it. And I just don't feel like, me personally, that I'm in a place where I'm ready to start doing those types of transactions. And if I was in a place where I was ready to start doing that I would only do a very small part of my portfolio to free up some of the cash that way. But it is a good option for people who are to the point where I call them ready to park their money. So you have enough to put it into, say, farmland that doesn't perform that well, but it's extremely stable. It's not volatile. That's the place where you park money. Boring things like T-bills. But doing things on margins would be like almost to the point where you can park your money, even though it's not parked, because you have enough that you have to live on. And if you lost everything that you had out, then it really wouldn't affect your well-being. It might just put a little pinch on your lifestyle, but you're not keeping yourself up at night. That is a way to do it. I don't know how to do it. I don't know. Does anybody in here, have they ever done that?
I haven't done it personally, but I was reading an article about a guy who did it. His neighbor's house went up for sale, and he wanted to basically control who he lived next to. He wanted to buy his neighbor, basically.
Yeah.
And so he put his stocks on margin to get the down payment and buy the place in cash. And he basically did a cash out refinance, or he basically just flipped it to somebody. He was able to choose the buyer. And that worked out well for him over the course, I think it's like over 8 months. So it was a short time span when the market wasn't super volatile. And I think the takeaway that I had was the call on the margin was relatively conservative. So he wasn't at a high risk of ever having that come out. And so he was just able to use that liquid cash for that duration and then basically put the margin away.
This is very similar to the personal line of credit or the credit card way of buying assets and investing. So people talk about good debt and bad debt, and I don't think there's any good debt. I think all debt is risky debt. There's no necessarily good debt. It allows you to do some stuff if you're able to manage the risk. For me to say never to use debt is like telling someone that they can never chop something with a knife because they might cut themselves. If you learn proper knife safety and you keep your tools in good shape and you learn about how to take care of any wounds you might have have, or knowing that a cut finger is not the end of the world. You just stick a Band-Aid on it and move on. If we treat debt in very much that same way, then yes, we can use it to the degree that we feel comfortable. You're not going to give a knife to a child, but of course, you're going to use a sharp tool when you need to. So debt to me is like that. And a personal line of credit or credit card is the same. You would take out a personal line. I never do this when I'm getting a mortgage, but we try and go do it once a year, just get a personal line of credit where we can then use that money to go collect and buy some sort of an asset and then rapidly pay that debt off. And so at the end of it, I have an asset that I don't feel like was too risky for me to get a hold of. And margins would be very similar to that. You just make sure that you can handle the risk that you've taken on, the amount of money that you're basically borrowing against, and that you feel comfortable with it. Just be careful.
Yeah, it also, I would add, I have taken margin before for other purposes, and the rates are really what matters. I think like Schwab's rates right now have risen to where it's not really comparable to like a HELOC because of the interest rates. I think even though HELOC rates have gone up, everybody's different. If you have a ton of money in an account, they're going to give you better rates, right?
Yeah.
In your stock. So but that really matters. If you're getting like 8% on your margin, it's kind of hard to make money off of the arbitrage there.
Yeah, but I'm glad that you brought that up because we're talking about ways to free up cash. And in that conversation, everything's on the table. And then we all get to decide how we feel about the risk level. And it's the same thing I said about a first versus a second lien HELOC. I feel like a second lien is too risky for me. I don't feel comfortable with it, but I do feel comfortable with a first lien. But I know other people who don't even feel comfortable with a first lien. So it's really up to you to decide how much of your portfolio, your net worth you want wrapped up in those types of things that might be a little bit more risky, and then making those decisions based on what you think you can handle. Just don't become like one of those bad storybook tropes where you put it all on one thing and the ship goes down and suddenly all your relatives have to go beg on the street. While it would make a good movie, we've seen it so many times. You just want to make sure that that's not you. There's no one thing. And I've saw this a lot when people getting out of real estate to buy crypto. And then when crypto went down, they're kind of like, I got to sit around and wait. Now I own no real estate and my crypto's down. So just make sure that you diversify enough to feel safe because things will go up and things will go down.
I love the knife analogy, by the way. Thanks.
Yeah, every time I see my kid cut their finger, I'm reminded of that. So a finger cut is not too bad. I can handle it. I can weather it. It's when you cut your arm off with a table saw that might be a different story. But the next thing I wanted to mention is something that some people think is fairly similar to that risk profile. But one of my favorite ways to free up some extra cash is by a whole life insurance policy. It's an overfunded life insurance policy where I can overfund it and get the cash value, let it sit there for a few years to season, and then I can pull that money back out as a loan against the policy in order to go and invest. And basically, it's doing double duty because it's earning a small interest rate inside the policy. And then when I borrow it out, I can use that to go invest. And so it's called infinite banking. And if designed by somebody who knows how to design these policies, and they all argue about the best way to do it. So sometimes I like to have different policies designed by different insurance agents, keeping the commissions or their rate low for what they charge to put the policy together, how soon that money is going to be ready to be able to borrow back out, making sure that I can keep up with the minimum that I have to put in every year, or I'll lose basically the policy, so that there is some risk associated with that. And so you have to go in with the idea of exactly how much you want to be putting in every year. That's something you can comfortably commit to. And then I always purchase something that's called a paid up addition, which allows me to put more money in on the years that I have more money, but on the years that I, for whatever reason, don't have, I can just go with the minimum. Obviously, the more money you put into it, the sooner it's going to season or mature so that you can pull that money back out. But I do like having the flexibility because I don't know what I'm going to have. And some of these are advanced strategies for people who've already attained a certain level of wealth and comfort with risk. But I just want everybody to be aware that there are a lot of ways that you can work with your tax obligations, work with the cash that you have coming in to be able to get it to do double or triple duty. Like I'll put it in a HELOC and I'll pull that out. I'll put it in a life insurance policy, then later borrow against the policy, put it back in the HELOC, and then take that out and go invest with this. It can get kind of complicated, but the more you are familiar with the tools, the easier it gets. And as long as you have a good tracker for your policies and your various investments, then you'll find that it's not quite as complicated as you think. As long as I feel like I have a good CPA and a good insurance agent and a good mortgage lender, that team for me is a really important team to be working together so everybody knows what I'm doing, what's going on, and the mortgage lender can inform what the tax guy is doing and vice versa. That really helps me to keep track of it all. And having different providers gives me a diversity of opinion. So I might have more than one lawyer, I might ask more than one lawyer, different accountants, and I might switch accountants every couple of years just to make sure that they're catching errors or filling holes that the other one might have done. And so for me, I don't want to make it sound overcomplicated, but if you just start with one little thing and then just add one little thing a little bit at a time, eventually in a couple of years, you'll find that you're very comfortable with it. Once you have your life insurance policy in place, you might start looking around at your retirement account as a source of funds. And there are a lot of rules that you need to follow if you want to invest with your retirement account. It's totally possible. You're not going to be able to benefit from depreciation using your retirement account because it's already tax advantaged. And so you're not going to be able to save on taxes that you weren't going to pay anyway. And so if you're in a retirement account, the depreciation is not going to affect you as much. That's more going to affect you when you're using your own cash or when you're using capital gains from the sale of stocks or properties. The thing that you have to do first is to convert your retirement account into a self-directed account, and that will go with a custodian. You have 3 main custodians, and all of the other providers are third parties who go through those 3 main custodians. And if you want to go with one of the top level ones, that's fine, but you can also go with one of their third-party providers. You just have to compare fees, and they're going to charge you differently based on which bank you're using or how much money you have in there. You're going to get charged by the total amount of money you have in there, or you're just going to get charged some sort of a flat fee that can be kind of high. So sometimes you have to change it around. If you have very little money in there, you want one strategy, and as you build how much money you have in there, you might switch to a different fee structure so that it better fits what you're doing. Just have to be aware that there are fees to administer your self-directed retirement account. You can get a self-directed account of any type of tax-advantaged retirement account. So you can have a self-directed IRA, a self-directed Roth IRA. You can have a self-directed HSA, which is the health savings account. And that's a way that people who are self-employed are able to invest their health savings account into things like real estate so that they can use a very inexpensive, high deductible policy and then have the deductible inside of that self-directed HSA that then can use if they, for whatever reason, want to become self-employed. They have a great insurance option. And so that's one way to be able to free up some time so that you can become self-employed without having to worry about your health insurance. So you can also have a self-directed 401k or solo 401k, which is a 401k that is designed for people who are self-employed. And I would say that if you're going to be investing in real estate, the solo 401k is probably the most tax advantaged because you're not going to have to pay UBIT taxes. And if you are investing through your self-directed IRA or other type of retirement account, you will have to pay those with real estate. And basically what it is, it has to do with the debt that you're taking out. You're basically, when you sell something or you get a gain off of something that you have leveraged, that debt that you're basically taking out of the market or taking out of the investment, you get taxed on that. There's some other options where you're going to be converting it to self-directed IRA. You can invest in pretty much anything you want, except for don't invest in a whole life policy like the ones we just talked about. You have to do those with actual cash. You can't do that through your retirement account. You can't invest in certain collectibles, and there are some other restrictions about what you cannot invest in, but pretty much everything else is allowed. Real estate is one of the most popular ones that people like to invest with. They're self-directed accounts. So if you're self-employed or you have a little side hustle, consider converting it to a solo 401k. And if you are fully self-employed, consider using a self-directed HSA for your health insurance needs. And then you can go invest in that HSA, and all the money that goes into there is tax-free when it goes in, and it's also tax-free when it comes out. If you spend it either only on medical things, that's the best account to be tax advantaged on both ends, and it also helps your health insurance. So I would say the HSA and the solo 401k are my favorites. However, my husband has a W-2, and so he invests in what's called a Roth 401k because he gets an employee match. So the 401k money that they put in there as the match stays in there and continues growing, and that's not self-directed. We roll that over once he leaves that job into a self-directed, but right now it's just there. But the Roth, where we put our money in, we can take out the original contribution because we've already paid taxes on that money. And so we'll put it in there, we'll get the match, and then later when we need it, we'll pull it back out of the Roth, and then we'll go invest it in something else because we don't want that original contribution to be trapped in the Roth. We can take it in and out anytime we want. But once it's in there, you have an annual maximum of how much you can put in there, but you can take it out at any time you want. We do leave the gains in the Roth while he's still working because we can't get those out without paying taxes on them. So we do wait until he changes jobs to be able to roll that over. And when he gets to the point where he's ready to quit his job and become self-employed, then we'll roll all of it over to self-directed and use our self-directed HSA to replace our health insurance. So that's how you can get at the cash that's in your retirement account so you can get more control over how you're investing it and make your own decisions based on where it is. I think that the limitations in the 401k system where you can invest in mutual funds and stocks and these types of things have really led to a lack of information about other types of investing, because now everybody feels like that's in my 401k, that's what's safe, that's what's easy, and everything else that you can't do in a 401k is considered risky, because we've lost that knowledge of how to invest in those kinds of things, because the 401k identified certain things and it makes it look like those aren't risky and everything outside of that is risky. So if you feel comfortable making more of your own decisions, converting some of your retirement accounts over to a self-directed, as long as you're no longer working at that company, is a great option for you to get at more money that you can invest. And also then you can guide your potential investors through the process so they can free up their cash from their retirement accounts so that they have more say and more control over where and how they invest that cash. All right. Appreciate everybody coming. Would love to see you on Monday night at our regular club meeting. We've got the information right here in this graphic. This week, we have a club member who is looking at buying a deal and he's not sure if it's a good deal or not. And so he's going to bring it in and we get to help him tear it apart. So it'll be really educational. And if it ends up being a good deal, I think eventually we'll find a deal that we like and the club will actually sponsor it and we'll be the lead managers on it. That is definitely a possibility. So the more of them we look at, the more likely it is that we'll eventually find one that we want to buy as a club. So if you want to pop in there on Monday and just learn about how to tear a deal apart, please come. All right. We did have some really good participation during the middle of this one. I'm really grateful for that. I appreciate everybody coming and asking your questions.
Awesome. Thanks.
Thank you very
All
much.
right. Thanks everybody for coming.
Thanks,
Appreciate it. And then you can switch over to your investing portfolio, which now I am an investor.
I don't know if the screen is changing. I'm still seeing the sign-in screen.
Oh boy. I hate when I do that. Let's go back. Okay, thank you. If you see me do that again, I do it a lot because I have to manually switch tabs when I'm sharing the screen. So if you see it and nothing's changing and it looks like I'm talking about something that you can't see, just tell me sooner rather than later.
Sorry, I just always assume that I'm not paying attention.
You're not paying attention, Marcus? I will be recording. I'm going to edit this one. Obviously, we had some chunks that I'm going to have to edit out because I wasn't sharing the right screen. Sorry about that. And I will get this put up in the next couple of weeks. Keep an eye out for that. I'll put it both in the Facebook group and I'll put it on my really bad YouTube channel where I have 25 subscribers. So if you want to go find it over on YouTube, you can certainly hit subscribe. I'm not a YouTuber, but you can find it in both of those locations on the Facebook group and on the YouTube channel.